Copyright in these lectures is either owned by the ANU or a third party who has licensed the ANU to use it. Students may use the recording for personal study only. No lecture may be communicated online, copied or shared without the prior permission of the ANU.
Okay, we'll make a start. So the first thing to note is your mid-semester exam. The timetable is up, so it is on Tuesday, the 28th of August at 6:30 p.m. And you'll need to go to one of three venues depending on your last name. Okay, so if your last name is Adams through Lou, then you go to the ground floor of Barry Drive. If it's Lou through Way, then you go Barry Drive first floor. And if it's Wen through Zoo, then you go to the Croatian Club. Okay, so make sure you go to the right venue, otherwise you might find there aren't enough seats and they'll say you don't belong here. Go. Okay, so please make sure you go to the right venue. Now, when you want to go and look for this, right, and you Google ANU exam timetable, if you type in Finm 2002, it comes up. But if you type in Finm 7041, it doesn't come up. Okay, the reason for that is that someone in examinations decided to type in 70041. Okay, so we've asked them to fix that up, okay, but trust me, this is the venue you are at, okay, they've just put in one too many zeros, which is why you can't search for it. That should be fixed up today, okay, but whether you're in Finm 2002 or 7041, then you go to one of these three venues, okay? But you have to go to the venue where your last name is. There will be a seat for you based on your student ID. If you go to the wrong venue, they'll say, sorry, you'll have to go to the other one and you'll miss probably the first, well, if it's in the same building, not too much. But if you have to go to the Croatian Club, you're going to miss the first 10 minutes of your exam. Okay, I will talk about the exam in more detail next week, but just for those of you who are wanting to know what you need to study, okay, it's on the first 4 lectures. Okay, so your mid-semester exam is on the first 4 lectures. So today is the last lecture that is examinable. Okay, so today's lecture will be in the exam, as will the previous 3 lectures. You will have, thank you. I normally find when I talk about exams, people want to listen. When people listen, I'm nicer, I tell you more. So please be quiet. When you're ready, you two. Thank you. So you'll have 3 questions. Okay, 3 questions in the mid-semester exam, and they will contain multiple parts. So there might be a part A, a part B, and a part C. Most of the questions will be calculation-type questions. Okay, so in other words, you have to do something on your calculator, most probably. Okay, there will be a little bit of theory, but most of it will be calculation-type questions. Okay, so calculation-type questions. First 4 lectures, obviously, you have no formula sheet, right? All you bring is a pen and a calculator. That is all you'll need. Make sure it is a non-programmable calculator. In other words, make sure it is a scientific calculator. If it is a financial calculator, you can't use it. It will be hard to do this exam without a calculator. Okay, so make sure you only have a scientific calculator. If it is a graphics or financial calculator, it will be taken away. And most likely you will not be given a replacement calculator. So bring in a scientific calculator and a pen, and that's all you need, as well as your brain, okay, and to have done some study. To pass the mid-semester exam, know what we've done in the lectures and be able to do the tutorial questions. If you can do that, you will pass the mid-semester exam. If you haven't done any work, then clearly you will not pass, okay, the mid-semester exam. Okay, I would call the difficulty of the mid-semester exam about average. Okay, there's nothing easy in there, okay, but there's nothing too hard either. Okay, this first part of the course, we've kind of walked you into it, in my view anyway, you may disagree. We've walked you into it in what I would sort of term the easier topics. The more complicated ones come a little bit later. Okay, so I will put up a past mid-semester exam for you as well. Okay, I'll put that up hopefully tomorrow. Anyway, those are the venues. You have 90 minutes writing time. and you have 15 minutes reading time, you will get it done, as long as you know your stuff, very, very easily in 90 minutes. Okay? My only advice is, when you're done after an hour, don't leave straight away. It's only half an hour of your life. Spend some time checking your work. Okay? That is where 20% of the marks are lost, right? By making careless mistakes, writing down the wrong number, right? Not reading the question carefully. Okay? So just spend that extra half an hour, however much time you've got left over, if you do, just to double check your work. The mid-semester exam is optional. Okay? You don't have to attend it if you don't want to. It's also redeemable, which means if you do better in the final exam, then your mid-semester exam doesn't count. Okay? So whatever gets the higher mark is what will count towards your assessment for the course. Okay? But I will go into it a little bit more detail next week. And next week will be your opportunity to ask me questions like, do I need to know this? Do I need to know that for the exam? The only venue I will answer that question is in the lecture theatre, where you hear and it's recorded. If you come to my office, I will just answer point blank, it may be, it may be, it may be. Okay? Because no person should have an advantage over another person. Okay? But if you ask me, for example, next week, do I need to know how to draw the option trading strategies? I may give you an answer. Okay? So it may be no. It may be yes. Or it may be, it might be. Okay, but obviously if I tell you a no, then that is my guarantee you don't have to study something. Okay, but I'm not saying no at this stage. Okay, that is for next week. At this stage, everything we've done so far could be in the mid-semester exam, but depending on my mood and how attentive you are in listening, not talking, then the better mood I am, the nicer I am in terms of, yeah, okay, we won't have that in the exam. Okay, so again, you can Google that, ANU examination timetable. Just search for 2002 though, because the 7041, apparently they've classified you as 70041. If you do search for 70041, it does show up, right? But that will be fixed hopefully by tomorrow. But Tuesday, 28th of August, so a couple of weeks away, and lectures 1 through 4. Okay, lectures 1 through 4. So that makes sure that today's lecture, you've covered it in your tutorial next week. Okay, so it has been covered for you, okay, in the tutorial. Okay, so before we go into today's material, I am going to go through a question with you, a swap question, which hopefully will show up. I've been having difficulty with the document camera. There we go, good. Okay, so we're going to do this question first of all. And it's an investment. Okay, so it's not like in last week's lecture where you had a loan. This time it's an investment, so you want the highest possible interest rate. Okay, you want the highest possible interest rate, and we've got an intermediary who's taking a cut, and we're also not sharing the gains evenly. Okay, so one party is getting most of the gains. So this is probably about as complicated as I can get, okay, with a swap question. Okay, we've done everything we can pretty much do. Okay, so let's have a look at the question. So again, we've got fixed and floating interest rates. And remember, this is an investment. This is the return they're going to get. So company X can get a 5% fixed return and a LIBOR floating rate return. Company Y can get an 8.2% fixed return and a LIBOR plus 1% floating rate return. So who has the absolute advantage? Should be yelling this out. Company Y, okay, gets you want the highest interest rates because it's an investment. And company Y gets higher in fixed and higher in floating. Company Y, where does their, don't read the question, that tells you, but where does company Y's comparative advantage lie? In fixed, right? It gets 3.2% more there, but only 1% more there. So company Y has the comparative advantage in fixed, and company X has the comparative advantage in floating, which is the opposite of what they want. Okay, company Y actually wants the fixed, and company X actually wants, let me say it again. Company X, wants the fixed, and company Y wants the floating. Okay, so how do we come up with this particular swap for them? Okay. So let me first of all fix the typo I've made. Is there a typo? Sorry. No, it's okay. Okay, so let's first of all, we need to figure out what the differences are. So what's the difference in the fixed rates and what is the difference in the floating rate? So in the fixed rate, it's the difference between 5 and 8.2%, which is how much? 3.2%. And the difference on the floating is LIBOR and LIBOR plus 1%. So the difference is, what's our next step? Someone tell me. What's our next step? Net gains? Great, net gains. So to work out the net gains, it's the difference between fixed and the floating. So the difference between 3.2 and 1%, which is 2.2%. Next, the intermediary takes 0.2%. So the intermediary is going to take 0.2%, which means we're left with 2% to play around with. We're told that company Y will receive 0.75% of the gains, which means company X is going to get 25% of the gains. Okay, so for company Y, they're going to get 75% of the gains. So how much does that equal? 1.5%, just 3/4 of 2%. And company X ends up with, therefore, 25% of the remaining gains, so they end up with 0.5%. Okay, the intermediary took 0.2%. Of the remaining 2%, 1.5 goes to company Y, 0.5% goes to company X. Any questions so far? So that means company X, well, they wanted a fixed rate investment. The best fixed rate they could get is 5%. So how much did they end up with? 5.5%. Yep, the 0.5% gain on the swap plus the 5% here. Company Y, they wanted a floating. The best floating they could get is LIBOR plus 1%, but we make them 1.5% better off. So they end up with LIBOR plus 2.5%. And then we go ahead and we draw the swap. So we have company X, the intermediary, and company Y. So, company X, right, they want the fixed, but what do they end up investing in? The floating. Now, it's an arrow coming in because they're getting a return, right? They get interest payments received to them. And they invest at what rate? LIBOR. So we have LIBOR. Company Y, they want the floating rate, but instead they invest in the opposite, the fixed rate. And the fixed rate they get is 8.2%. So we have 8.2% going in. What is always your next step when I give you floating and fixed interest rates? What do you always do? Pay the floating rate all the way across. Okay, so whatever number you see here, you pay that all the way across the swap. Okay, in this case it's easy, it's just LIBOR. So company X pays the intermediary LIBOR, and the intermediary pays Y, the LIBOR. And that means company X now is nothing. It's receiving and paying out LIBOR. But we wanted company X to end up with 5.5%. So we make the intermediary pay company X 5.5%. Now the intermediary is receiving and paying out LIBOR, so they cancel out, and it's paying out 5.7%. So how much should it receive to get its 0.2% cut? 5.7. So company Y pays the intermediary 5.7%. And your swap is done, hopefully. So let's just make sure all those cash flows add up. So first of all, for company X, they're paying out. They are paying out LIBOR. They are receiving LIBOR. And they are receiving 5.5%. So those cancel out, and they get the 5.5% as required. Company Y, well, they receive LIBOR, they receive 8.2%, and they pay out 5.7%. So add that up, and you get LIBOR plus 2.5% as required. And then for the intermediary, they receive LIBOR, they pay out LIBOR, so they cancel out, and they pay out 5.5%, and they receive 5.7%. So they get their 0.2% cut as required. Any questions on that one? Yes? You want to see this? So why the arrow's going in? Yeah, it's an investment, so they receive cash flows, right? If it's a loan, they have to pay the interest. It's investment, they receive the cash flows. They receive the interest on their investments. So they're not loans, they're investments. So the money comes in from interest. Any other questions? Yes? This? Yes. Definitely. That is the swap. That's what you're asked to do in the question, is to design this. Any other questions? Okay. So let's have a look at today's lecture. Okay, so we're going to start off, so we've done with forwards and futures for now. So the next few weeks we deal with options. So today we're going to revisit some option terminology. We're going to talk about some, thank you, we're going to talk about some option trading strategies. And then for the next 4 lectures, we value options. Okay, so we find out what should that option premium be. How much should I pay for the option? So next week, we use a model that helps you value American options. And then after that, we look at valuing European options. And then we look at valuing options on things like forwards, futures, currencies, and indices. Okay, how we value those. And we use both what we call the binomial and the Black-Scholes option pricing model. Okay, but today, we're going to look at some of the things we can do with options. Okay, so we know there are 2 main types of options. There are call options and put options. And the options give you the choice, right, but not the obligation to buy or sell at a certain price. And it's the person who's in the long position who gets to make the choice. If you're long in a call, you make the choice about buying. If you're long in a put, you make the choice about selling. If you're short in a call or short in a put, you don't get to make a choice. You have to do whatever the person in the long position decides to do. So if they decide to exercise the option, you've got to do what they want. If they decide not to exercise the option, then you don't do anything. And in fact, that's what you want. As the person who's short, you don't want the option exercised, because then you walk away with the option premium. Okay, remember, that's why you're short in an option. You get paid the option premium up front, and you have different views about what will happen to the direction of asset prices, the underlying asset price. So you're hoping that the option doesn't, okay, get exercised. Okay, so in terms of the payoffs, so we'll actually do this on the document camera. Okay, so with our options, long equals holder equals choice equals pay premium. So whether you're long or a call and a put, whether you're long in a call or a put, you're the holder, you get to make the choice, and you have to pay a premium. If you're short, then you're the writer, you're obligated, so you don't get to make a choice, and you receive the premium up front. And then we think about payoffs. So payoffs are all about, A, do I exercise the option? And if I exercise the option, how much money do I get or lose if I'm the writer? Okay, so payoffs are about what happens at exercise. It does not include the option premium. Okay, doesn't include the option premium. That would be the profit. Okay, and then the kind of funny thing, or the kind of thing that falls a little bit out of place, is that with options we kind of ignore the time value of money when we talk about payoffs and profits. Okay, we kind of ignore that something's happening 6 months in the future or something like that. Okay, so we just look at what happens at that particular date, so therefore we ignore time value of money today, to an extent. So our payoffs, if you're long in a call, when do you exercise the option? When what's higher than what? When the spot price is higher than the exercise price. So your payoff is simply going to be, if you like, the spot price minus the exercise price. Because when you exercise it, that is going to be your payoff, ST minus X. But what happens if you don't exercise it? What would your payoff be? 0. So it's either ST minus X or it's 0. And the way we express it is, it's the maximum of ST minus X and 0. So in other words, if ST minus X gave you a negative amount, so the spot price is below the exercise price, you wouldn't use the option. If the exercise price is $10 and the asset's selling for $5 in the marketplace, you're going to go to the market and spend $5 rather than the $10 exercise price. So in that situation, you'd have negative 5 and 0, so the payoff would be 0. You don't exercise the option, right? You go to the market instead. And then if you have a short call, then it's going to be the minimum of X minus ST and 0. So if the option doesn't get exercised, so if the person in the long position decides not to exercise the option, you end up with 0. If they do exercise it, you're going to start making a loss. Right? So their $8 payoff will be a negative $8 payoff to you. Has to cancel out. That's why it's the minimum. It's always going to be 0 or less. You're never going to get a positive payoff. If you do, the person in the long position's been really, really, really silly. Right? Doesn't happen. Then we have our long put, and that is the maximum of X minus ST and 0. Okay, it'll be exercised when the exercise price is greater than the spot price. So if the asset's worth $10 in the marketplace, but the exercise price is 20, you're definitely going to use the option because you'd rather sell it for the exercise price of 20 than in the marketplace for $10. Again, if exercising would lead to a loss, you don't exercise it and you make a payoff of 0. And then if you're short in the put, it's the minimum of ST minus X and 0. Any questions? So then the other terminology we start talking about is moneyness, right? The moneyness of the option. So we have in the money, at the money, and out of the money. So in the money simply means this option if you could exercise it, you would, because you'd make some money. In other words, you would make that decision to exercise the option because with a call, the spot price is higher than the exercise price, or with a put, the exercise price is higher than the spot price. At the money simply means the spot price is equal to the exercise price, and out of the money means you wouldn't exercise the option because exercising it would lead to a loss. So in the money, for a call, the spot price is higher than the exercise price, so that means yes, you'd exercise it. And for a put, the exercise price is higher than the spot price. Out of the money means you don't exercise it. So for the call, the spot is lower than the exercise price, and for the put, the exercise price is lower than the spot price. So you would not exercise the option. At the money, for both, just means that ST equals X. Okay, so you're indifferent whether you use the option or not, because there's going to be a zero payoff anyway. So types of options we have. Of course, we have options on stocks. We call them stock options. Most of them are American in nature, which means they can be exercised at any time. Okay, now, tomorrow, all the way up to the expiry date. Okay, in Australia, they're traded on the ASX, the Australian Securities Exchange. You can also have foreign currency options, so options on US dollars, options on Japanese yen, options on euros. Okay, over the counter, more and more so though on exchanges, and they can be either European or American. So remember, European only exercised at expiry, American any day. And then index options, these are options on indices. So options on the ASX 200, the top 200 companies in Australia by market capitalisation. Okay, and these are generally traded on exchanges, and they are mostly American, but you can have some over the counter as well. So futures options, we spend a whole lecture on futures options. So don't worry about it today. I'm just going to introduce to you what futures options are, okay? But don't stress about it. It's not going to be in your mid-semester exam. You have a whole lecture on futures options coming up. What are futures options? Futures options are options on futures contracts. So it's a derivative on a derivative. So you might have an option on a futures contract on gold. So it's a derivative on a derivative on gold. What happens when you exercise the option contract is two things. One, you end up with a position in a futures contract. So when you exercise it, you'll get a futures contract. And you'll also get a cash amount equal to the difference between the futures price and the exercise price of your option. But we spent a whole lecture on it. We're just introducing them today. So don't worry about it. Don't stress about it. Just know at this stage, there's something out there called futures options, which give you an options over a futures contract. When we cover it in the lecture, we'll look at all the cash flows and we'll look at how we value these things. Now, when you've looked at in Foundations of Finance and you've spoken about dividends, and we've done forwards and futures prices, right, and we've taken into account dividends, with options contracts, dividends can have an impact on the terms of your option contracts. Okay, if there's just cash being paid, so it's just a cash dividend, then there's no impact. Okay, but a lot of the time, these options actually end up with dividends. So sometimes these dividends, end up with stock being issued to you. So your dividend, rather than a cash payment, might be a percentage of shares in the company. Okay, so for every 100 shares you own, your dividend might be 5 new shares. So rather than getting cash, you get stock dividends. So that actually adjusts the terms of your options contracts, okay, if dividends are paying out stock. Okay, and so we have to think about how do we handle these. Okay, so this example here, consider a call option to buy 100 shares for $20 per share. So that's the option that's out there. Then imagine two things happen. First of all, there could be a stock split. So companies we know have a share price. And the investor behavior is, if I said you have $10,000 and you can buy shares in this company where the share price is $1, and you'll end up with 10,000 shares, or you can buy shares in this company where the share price is $10,000, so you'd buy one share, and these companies are both equally good, so you'll get exactly the same return. So in theory, the decision should be neutral, right? They're identical cash flows you'll get, identical amount of investment you've put into the companies. The investor psychology is that 90% of you would go for 10,000 shares at $1, because that sounds better, even though it's exactly the same as one share at $10,000. So companies, what they tend to do is do stock splits if their share price gets too high. Okay, so if you own 100 shares and the share price is $100, they'll give you another 100 shares, but the share price drops to $50. So it splits the price in half. Your total wealth, though, is exactly the same. Okay, number of shares has doubled, share price is halved, your investment is exactly the same. But getting that share price lower means that more people, there'll be more liquidity, hopefully, people will be wanting to buy more shares in that company. So that's why companies do stock splits. So if you look at a company like Disney, right, Disney's had about 6 or 7 stock splits because its share price has just gotten so high. Okay, and they're concerned about people wanting to actually be able to buy shares in that company. So how do we take account for it? Well, that example should be pretty easy. If you're going to have a 2-for-1 stock split, which means you double the number of shares, then your option should also be over double the number of shares. Kind of makes sense. We'll see that in a second. And then a 5% stock dividend, well, there's going to be a 5% impact on the number of shares, but also on the strike price as well. So let's do that on the document camera. Okay, so we have our stock splits, first of all. Okay, so the exercise price, remember, was $20, and the number of options was equal to 100. Okay, options over 100 shares. So how do we adjust for the strike price? Well, it's a 2-for-1. So for every 1 share you have, you're now going to have 2 shares. So they're doubling the number of shares you own. So on the numerator, we have, well, this is what I have at the moment, 1 share. And the current strike price is $20. And then on the bottom, I have how many shares will I have now? Well, for every 1, I'll have 2 shares. So the strike price now halves to $10. Because that's what's going to happen to the share price of the company. If they double the number of shares on issue, but they don't raise any new capital, right? They're just giving you a new share as a shareholder. Market capitalization has to stay the same. So if the number of shares double, the share price has to halve. And that's what's happened with our exercise price. And now for your number of options, it's kind of like the reverse. Well, how many will I have now? I'll have 2. I did have options over 100, and that was when I had 1. So now I have options on 200 shares. Makes sense again. They've doubled the number of shares on issue, so you should get double the number of shares in terms of the what your option is over. And then it's a similar strategy for stock dividends. So our strike price, so with our stock dividend, it was a 5% stock dividend. So you're getting 5% more shares. So I own 1 share. and the strike price was $20. Now I'm going to get 1.05 shares, okay, 5% more shares, 1.05. So that gives me a price of 19.047 is the new strike price. Okay, so all I've done is the same as before, but now, rather than getting double the number of shares, I get 5% more shares. So it's just 1 plus 5%. And then for the number of options, well, now I have 1.05 or 5% more shares because I get a 5% stock dividend. It was over 100. Sorry, it was multiplied by 100, sorry. That was the number of options. So I now just have options over 105 shares. Okay, some other types of options in the marketplace. There are things called warrants. So with a warrant, this is when a company issues options on its own stock. Okay, so Telstra, if Telstra issues warrants, when the option gets exercised, what's going to happen is that Telstra will give shares to the person who exercises the warrant, and it's like issuing, if you like, new shares in the company. Okay, so Telstra's issuing new shares in the company at that exercise price. So it's like a primary market. New stock will end up being issued. Okay, but it's just in its own stock of the company. And you can only issue warrants in your own company unless you have a deal with another company. Okay, executive stock options. So executive stock options became popular, more popular, I should say, in the 90s, but they're also in the 80s as well. So what happens with executive stock options is that you have different ways of paying your executives, okay, the people who run the business for you as a shareholder. So you can give them a salary, and then if they don't perform, you fire them. Or you can try and align their interest with your interests. So you as a shareholder, what's your interest? What do you want to happen? You want the share price to go up. You want to get dividends, right? You want the company to maximize its profit because when the company maximizes its profit, the share price goes up and dividends go up. So the way you can do that is, there's a few ways. One, you could just give executive shares. So give them shares as part of their remuneration. Now that they hold shares, they have an incentive for the share price to go up. They have an incentive for dividends to go up as well, right? Because that will increase their wealth. The problem, though, is that when this was done in the 80s, executives did things in the short term. So they did risky things. They did really risky things. What happens when you have a lot of risk? What should you get? A high return, right? So they did really risky things, and in the short term, share price went up, right, because they were going to do all these amazing things that would increase revenues in the future. Share price went up, got a lot of money out of these shares they were issued, and then they left. And turns out their decisions weren't so good. They were risky. What happens with risk? Okay, high expected return, but also high probability of losses. Okay, so that was the 80s sort of gamble with this. Didn't work out too well. So then in the 90s, we had executive stock options, and we said, okay, let's not give them shares now, let's give them options with an exercise price. So let's imagine the current share price of the company is $10. Let's give them call options with an exercise price of $15. And they can't actually exercise these options for 10 years from now. Okay, so it's a long period of time. So they can't do short-term things to stuff up the company. They have to be doing medium-term things to increase the share price. And then hopefully in 10 years' time, the share price is a lot higher. They exercise these options and buy the shares for cheaper and get a bit of money. Problem was, executives weren't forbidden from trading in these options. So if I've given you a long call option, how can you turn that into money? Okay, if I'm long in a call option, I'm an executive, right? Dodgy Salt Incorporated. I've been given options, and those options, let's imagine the premium of those options is worth $5 million. But I can't exercise them for another 10 years. What could I do instead? I could sell the option, right? So I give them to someone else, they now become long in these options, and I walk away with the millions of dollars. So that's not very good. That defeats the purpose. So then in the 2000s, pay executives with these stock options, they have a long period of time before they can exercise them, and they're not allowed to trade in them. Okay, so not allowed to sell them to someone else. And they're not allowed to write short options. That could be the other strategy. Write short call options, so you get the premium now and they cancel each other out later on. Not allowed to do that either. Okay, so they obviously have this long period of 10 to 15 years. And that's to try and incentivize managers to have the same interest as shareholders. And of course, because they've got such a long period of time, if they get fired or resign in the medium term, they'd expire worthless. So it's kind of like a handcuff to keep you at the company. Okay, because if you leave, you're going to lose these millions of dollars in options. But the company can fire you for not performing and you lose them anyway. So it gives a lot of power to the company as well. Convertible bonds. So convertible bonds are kind of, we also call them hybrid bonds. And we think of them like an option because normally when you have a bond, we know there are coupons that get paid and the face value gets paid back. With a convertible bond, the company that sold the convertible bond, so my company sells convertible bonds to you, you expect to get coupons every 6 months and the face value back at the end. But I've disclosed to you it's actually a convertible bond, which means at any point in time, I, the company, have the option of converting these bonds into equity, into shares. So I say, your bonds are cancelled, but here's some shares in my company. What do you think the problem with that is? When do you think I, as the company, would be most likely to do that? Convert your bonds into equity in my company. When might I do that? Sorry? When I'm short of money, when I'm not doing very well, when I can't pay the coupons, when I can't pay the face value of bond. And I'll say, hey, you know what? Let's cancel all your bonds and I'll take the cash. Okay, so in return, that's kind of like an option, right? Because I get to make the choice. But in return, obviously, for you investing in this convertible bond, the coupon rate's going to have to be higher than a standard bond. Because you face the risk that I could convert your valuable bonds into worthless shares in my company if I'm not doing well. Okay, so this is some notation you should all be familiar with from Foundations of Finance. So C, or lowercase c, call option premium with Europeans, capital C, American call option premium, lowercase p, European put option premium, capital P, American put option premiums. We have S0, that's the stock price at the beginning, ST is the stock price at the end. So 0 times 0, T times T, that's at the end of the time period. We have X, our strike price, D, present value of any dividends, T, the life of the option, R is my risk-free, remember it must be continuously compounded. And then this one down here, and this will become more apparent in a couple of weeks' time, we have the volatility of the stock price. So how volatile is the stock or the underlying asset? And the more volatile the stock, the more risky there is, right? So volatility here is measured by standard deviation. Standard deviation from Foundations of Finance is a measurement of risk. The higher the risk, the higher the return, if you like. So the more expensive options become. And so this is what this table here is. So we'll do this in a couple of weeks' time, but just to look at it briefly now. As you increase the spot price, or as the spot price gets higher, that should have a positive impact on the call options because your payoff is S minus X. So if you keep X constant, as S goes higher, there's going to be a bigger payoff, so it should be more expensive, the option. For put options, it's the reverse, right? It's X minus S. So as S becomes bigger and X stays the same, you're going to get a lower payoff. So the put option should be less expensive. And then the opposite, obviously, with the exercise price, it's S minus X for a call. As X goes up, lower payoff, call option premium should be lower. With a put option, it's X minus S. As X gets better, gets higher, bigger payoff, so the option should be more expensive. So it's a positive relationship. Time, I kind of think it should be positive all the way across. This is what your textbook says. It's sort of unknown with Europeans. I kind of think as you increase the time, you increase the risk, you increase the uncertainty, so they should become more expensive. That's my thought anyway. Volatility, standard deviation, yes, as you increase risk, you increase the option prices. Okay, as you increase risk, higher expected returns, so options should become more expensive. We'll skip the risk-free, we'll go down to the dividend. When dividends get paid, they reduce the stock price. Right, so that's going to be bad for call options because as S gets lower, lower payoff, but it's good for put options. As S gets lower, bigger payoff for put options. Okay, that's because when dividends get paid, stock prices drop. So R is my risk-free rate. Risk-free rate. So who can remember CAPM? Everyone should say yes, right? Favorite formula, CAPM, capital asset pricing model, which is risk-free plus beta multiplied by the expected return on the market minus the risk-free rate. What's the starting point? The risk-free rate. So as the risk-free rate goes up, what should also go up? Your expected return. Right? Your expected return should get higher. Because as you take on risk, you demand to at least get the risk-free rate of interest. So as the risk-free rate goes up, spot prices should also go up. Good for calls, from what we said before, bad for puts. Any questions? American versus European, we know this. Americans should be more expensive. The reason they should be more expensive is you get to make that choice. Okay, you get to make that choice and you have to pay for that choice. Okay, so we're going to look at option bounds. We'll do the upper bound before we have a break. So when we talk about bounds of option prices, we're talking about what's the most you should pay for the option. That's the upper bound. And what's the least amount you should pay for the option. That is the lower bound. If these bounds get violated, you can make a riskless arbitrage profit. Okay, and that's what we're going to do in nearly every single lecture from now until week 10. Make arbitrage profits using great tables which you'll grow to love. Because you have to do them over and over and over again. And it will definitely be in your final exam. Okay, so let's talk about the upper bounds. This is the most amount of money that you will pay for an option, right? So we're talking about the option premium, right? That premium that you pay. So upper bounds. So what is the most amount of money you would pay for the option? So first of all, we have a call option. So what is a call option? Well, if you're going to buy a call option, you're going to be the holder. You get the right but not the obligation to buy the underlying asset. Okay, that is what you're buying. So let's imagine the underlying asset's worth $100. And we're trying to find C, right? C, the call option premium. So what is the maximum amount that should be? Well, you could sit here and you could think, well, the stock price could go up to $1 million. So how on earth do I figure this out? Right? Obviously, if the stock price goes up to $1 million, well then maybe paying $500,000 isn't such a bad thing. I make a $500,000 gain. No, not the case. Right? So if the current stock price is $100, what's the most you would pay for this option? Who would pay $200 for this option? Good. Who might pay a cent for this option? Sounds good to me. What about $101? Who would pay $101 for this option? Remember, the stock price could go up to $1 million. Good. You're never going to pay more than the current spot price. Why pay $101 for an option on the stock when you could go and buy the stock for $100, $1 less? Right? You're never going to pay $101 for an option when you could actually buy the physical underlying asset for less money. You might as well just go and buy the asset for the cheaper amount. So the upper bound, the most amount of money you will pay is the spot price today of that asset. Imagine it was selling for $110. Arbitrage would be, I'm the writer, I'll go and sell an option for $110, buy the asset today for $100, $10 gain. And I owe the underlying asset, so if it gets exercised, I can deliver it. Doesn't get exercised, I go and sell the asset and make another, however much it's worth. All right, so it's never going to be more than the current spot price. And with a put option, let's imagine the exercise price is $100. So if the option gets exercised, you'll end up with $100. Would you ever pay more than $100 to buy this option if the maximum amount of money you can make is $100 or receive is $100 from exercising the option? No, of course not. Good answer. So the put option premium must at least be less than the exercise price. Less than or equal to the exercise price. And then because this is kind of all in today's dollars, we think about it, well, this exercise price occurs in the future. This is one of the few situations where we actually do take into account time value of money. Right? If you're going to receive $100 in a year's time, you'd pay no more than the present value of $100 today. Otherwise, you'd lose some money on this if you don't exercise it. So this is one of the few situations where we do look at the time value of money when we talk about payoffs, if you like, which is kind of what this is. Any questions? Yes?
Why do we consider the time value of money for when you're buying the option later?
For, which for this one here? For the call option? Okay, because for the call option, you're going to do all those cash flows today. You're going to buy the option today and you would buy the stock today if it's the arbitrage idea of it. Down here, the cash flow you receive is not for another year's time. All the cash flow occurs at this point here, time 0, whereas down here, you get the exercise price in a year's time. Okay, whereas here you buy the option today and you would buy the asset today. Right, whereas here the cash flow is in a year's time. Any other questions? Okay, so let's take a break for about 5 minutes and then we'll come back and look at lower bounds. Okay, we'll make a start again. Okay, so we've done the upper bounds. Now we're going to have a look at the... Thank you. Thank you. Now we're going to have a look at the lower bounds. This is working out what's the least amount of money the option should be selling for. Now, in this course, we do no mathematical derivations. Okay, that's good news. We do no mathematical derivations. Instead, we do like this table. And the reason we have to learn how to get these formulas using the table is because that's what you're going to be doing week after week when we work out the arbitrage profits. Okay, so how do you make riskless profits if these bounds are violated? Okay, so what we're going to do is we're going to look at the lower bounds, we're going to look at core parity, and we're going to create them or get them using two portfolios. Not a mathematical one, just a logical, common sense, hopefully, table format. Okay, so first of all, we're going to look at the lower bounds of call options. Okay, so lower bound of options. And the first one is to look at the call option lower bound. So the lower bound for a call option is that the call should be greater than or equal to the maximum of S0 minus XE negative RT and 0. Now, if you kind of look at that, that's really just the payoff of ST minus X at time 0. So ST at time 0 would be S0. X at time 0 would be XE negative RT, just the present value. So in terms of remembering, it's kind of easy. It's just take the payoff and then put in its present value numbers. But what you need to know how to do, and this is something that could be in your mid-semester exam, will be to show me how we get that lower bound using a table. And we get it with two portfolios. Okay, we have portfolio A and portfolio B. Portfolio A is comprised of two things. One call option. Okay, so it's got a call option in there. And it's got some cash equal to the present value of the exercise price. So portfolio A has a call option and some cash equal to the present value of the exercise price. Portfolio B has 1 unit of the underlying asset. So that's just equal to S0, its spot price today. 1 unit of the underlying asset. One call option, its value is C, call option premium, and some cash equal to the present value of the exercise price. Okay, so you need to remember this. And then we draw a table. Okay, at time 0, what do I have in portfolio A? A call option and cash equal to XE negative RT. So what is portfolio A worth in total? C plus XE negative RT. Okay, so that's what portfolio A is worth at time 0. What's in portfolio B? What's it worth? S0. Right, it's just worth S0. Now we have to have a look at what happens at maturity. So in other words, what happens at time t, at the end of the life of this option. So, the spot price, the final spot price, can either be worth greater than or equal to X, or it can be worth less than X. That's important, not for the stock, not for the exercise price, but for the call option. That'll tell us when the call option gets exercised. So when does the call option get exercised? So, I promise you, After the mid-semester break, when you've done these tables 4 or 5 times, you'll be yelling this out, I hope. When does the call option get exercised? When ST is greater. Excellent. Greater than X. And what is my payoff? ST minus X. Okay? So the call option gets exercised, and at the end, the payoff is ST minus X. What about over here? What happens to the call option? 0. It doesn't get exercised, so the payoff is 0. Here it gets exercised, your payoff is ST minus X. Here it does not get exercised, it expires worthless, so its value is 0. Here the value is ST minus X. What about the present value of X? What does it grow to be equal to? Assume you've invested at the risk-free rate of interest. It grows to be equal to X. Fantastic. So what is portfolio A worth when ST is worth more than X? ST, fantastic. The X's cancel out. ST minus X plus X, you're left with ST. What about over here? What's portfolio A worth? Just X, 0 plus X. Excellent. What is the stock price worth at the end, or the stock worth at the end? ST and ST. No matter what happens, it's worth its value at the end, ST. So portfolio B is just equal to ST. Okay, so when ST is greater than or equal to X, so this case here, both portfolios are worth ST, so they're equal to each other. So portfolio A is equal to portfolio B, right? They're both worth ST. Everyone okay with that? So they're equal to each other. When ST is worth less than X, then which one's worth more, portfolio A or portfolio B? A. A is worth X, which is higher than ST, which is portfolio B. So A is worth the higher amount of X, B is worth the lower amount of ST. By definition, ST is worth less than X. So A is greater than B. So that means in all situations, A is greater than or equal to B. It's never worth less than B. What is portfolio A? It is C plus XE negative RT. What is portfolio B? It is S0. Rearrange. C must be greater than or equal to S0 minus XE negative RT. But can a call option premium ever be worth less than 0? No, can't be negative. So C is greater than or equal to the maximum of S0 minus XE negative RT and 0. So that is your lower bound that you've proved there using this table. The call must be worth at least S0 minus XE negative RT. If that number is negative, then it has 0 value. A call option cannot have a negative value. Okay, so it's the maximum of those two things. And there you have non-mathematically derived the lower bound for a call option premium. And then you'll go on in future weeks to do arbitrage profits based on this. Does anyone have any questions about this strategy at all? Not a strategy, sorry, about what we've done here. 2 portfolios, put them in a table. There's only 2 situations that can occur in the world. Essentially, if the option gets exercised or it doesn't. Those are the only 2 scenarios. And allows us to derive the lower bound. Now, if there's a lower bound for call options, there must be a lower bound for put options. So for a put option, again, we have 2 portfolios. Portfolio C has a put option and 1 unit of the underlying asset. Portfolio D has cash equal to the present value of the exercise price. Okay, present value of the exercise price. Again, we draw a table. We worry about what happens at time 0, and we worry about what happens at expiry or time t. Again, the spot price can either be greater than or equal to x, or the spot price is worth less than x. So portfolio C has the put option and 1 unit of the underlying asset. So in total it's worth P plus S0. And portfolio D has that cash equal to the present value of the exercise price. So it's just equal to the present value of the exercise price. So that's at time 0. Now we have to worry about what happens at time t. So when does the put option get exercised? When ST is less than x. Less than x. And what is the payoff? X minus ST. What's the payoff over here? 0. It doesn't get exercised. Put option doesn't get exercised. Value is 0. Here it does get exercised. The payoff is X minus ST. What's the stock worth at the end? And that's in both situations, right? Whatever ST ends up being. So this gives me ST, and this gives me X. The STs cancel out. What does my cash grow to be equal? Just X. So portfolio D is just worth X at the end. Okay, so when ST is greater than or equal to X, which portfolio is worth more, C or D? C, right? ST is worth more than X, C is worth the higher ST, D is worth the lower X. So C is greater than D. Over here, when ST is worth less than X, they are worth the same. C is worth X, D is worth X. So C is equal to D when ST is worth less than X. So in all, C is greater than or equal to D in all situations. Same as before, what is C? It's P plus S0, and that is greater than or equal to D, which is XE negative RT. Get the S0 on the other side. P is greater than or equal to XE negative RT minus S0. And again, because we can't have a negative value, we say P is greater than or equal to the maximum of XE negative RT minus S0 and 0. And that's the lower bound for a put. And again, that's just the payoff of a put in present value terms. It's X minus ST is the payoff. Well, here, present value of X, and the present value of ST, is, if you like, is just what is S0 today. What's the stock worth at time 0 today? And you have derived, using a table, the lower bound for a put option. What is left? Put call parity. Put call parity. Again, two portfolios. Portfolio E has a call option and cash equal to the present value of the exercise price. Portfolio D has a put option and 1 unit of the underlying asset. Again, we draw our table. We have time 0, we have time t, and we have either ST's greater than or equal to X, or ST's worth less than X. So the same format every time in terms of the table. This doesn't change. It's just what's in the portfolios. So in portfolio E is a call option and cash equal to the present value of X. So that's C plus XE negative RT. And portfolio D, a put option and 1 unit of the underlying asset. So P plus S0. And then what you've done in the previous two tables, you now just do in this table. So where does the call option get exercised? You just yell out greater than or less than. When does it get exercised? Okay, mumbling, it's okay. We'll get there. Greater than, that's right. Greater than. Okay, so my payoff is S, T, minus X. Payoff here is 0, fantastic. Doesn't get exercised. What does the cash grow to be equal to? Out loud, x. X, excellent. ST minus x plus x gives me 0 plus x gives me. Okay, so at the end, this portfolio is worth ST. Here it's worth x, depending whether the spot price is greater than or less than the exercise price. Where does the put option get exercised? Greater than or less than? Less than, fantastic. And the payoff is? X minus ST, fantastic. What's the payoff here? What do I write here? So 0 plus ST gives me ST, X minus ST plus ST gives me X, cancels out. So when ST is greater than or equal to X, portfolio E is equal to portfolio F. They're both worth ST. When ST is worth less, don't know what that was, less than X, they are both equal. They're both worth X. So that gives me C plus XE negative RT equals P plus S0. Okay, so what you've proved there is put call parity. Not the lower bound, you've proved put call parity. So this is what you did in Foundations of Finance, same formula, except this was X times 1 plus R to the power of negative T. Now we're in continuous compounding. So this is your put call parity formula from Foundations of Finance. And what you've done now is derive it from a table. Not mathematically, just from a table using two portfolios. Okay, that is your put call parity formula. Any questions? So this is like a classic theory question for an exam. Not saying it's going to be in your exam, but just saying in the past. This is all about, should you ever exercise an American call option on a non-dividend paying stock early? Right, so this is an American call option on a stock that does not pay a dividend. And the rule is you should never exercise it early. Reason for that being, the first one, no income is sacrificed. What does that mean? Well, if a stock pays a dividend, then obviously I've got an incentive to own the stock, because if I don't own the stock, I don't get the dividend. So if I've got an option on a stock and a dividend gets paid, I don't receive it. So maybe I want to exercise the option early to own the stock and get the dividend. But in this case, as there is no dividend, there's no incentive to exercise early to get any income because there is no income. So that's the first reason. The second reason is we delay paying the strike price. So whenever you exercise the option, you have to pay X dollars. I would rather pay X dollars a year from now than X dollars today, simply time value of money. So if the exercise price is $10, if I pay $10 today or $10 a year from now, $10 a year from now is obviously better. Okay, because that's about $9.50 today, as opposed to $10 today. The third reason is providing insurance against the stock price falling below the strike price. So that's a lot of words. What does it mean? Well, if I exercise now and pay $10, what if in 9 months' time the stock price dropped to $9? I've missed out on that situation. So essentially what it's saying is, hold off, right? You've got a maximum amount of money you'll pay, which is $10, and then just see what happens to the stock price as you go along. Okay, because if the stock price drops, you're better off not exercising your option and paying less money. Okay, so you've got a ceiling, a maximum amount you'll pay from buying that underlying asset. That's all that talks about. Okay, these are lower bounds. What's the impact of dividends? Simply, all you do is take the present value of the dividend and, if you like, subtract it from the spot price. Okay, which is what we have for the call option, so present value of D. In the formula below, you can either add on the present value of the D on the left-hand side or subtract it over there. It'll end up giving you the same thing, okay, because you're going to reduce the spot price. And then extensions of put call parity. So these are on American options, dividends. I've got a note there. I'm going to be nice. You don't need to know how to derive them. That's true. You're also not going to be examined on these. Okay, so I don't expect you to learn these formulas. Okay, you might have tute questions on them. In fact, I think you do next week. But I do not expect you to know, okay, let me be careful here, slide 27's formulas. Okay, everything else, yes, but slide 27 of lecture 4, you do not need to know those formulas for your exam. Okay, but in tutes, you'll have to use them, okay? But you won't be quizzed on them, you won't be examined on those formulas there. You've got enough formulas to learn. Okay, option trading strategies. Okay, so option trading strategies. Students kind of get a little bit worried because there's a lot of detail here. Okay, there's a lot of detail here. Today, we're just going to concentrate on what these things actually do, what they allow us to do, and not get too caught up in the diagrams or too caught up in where you make profits and losses. You'll do that in your tutorial next week. Okay, so your exams, let's be nice again. You will not need to know how to draw these, okay? But you will need to know what they do, how you create them, right, which we're going to go through, and where you would make a profit, okay, which you'll do in your tutorial next week. But I'll take away the drawing side of it, okay? So you will not be examined on drawing these. But you need to know what they are, how you create them, and where you would make a loss or a profit on these strategies. Okay, so here we have, these are what we call synthetic options. So this is a situation where, imagine you can't buy a call, you can't buy a put, you can't sell a call, you can't sell a put. How could you replicate them using the underlying asset and another option out there in the marketplace? So the solid line you see in these diagrams is the net overall position. So that's combining the positions of the two dotted lines you see on the plots. So for diagram A, what does a solid line look like? Oh, come on. Just because you don't have to draw them doesn't mean you shouldn't know them from foundations. Looks like a short put. Looks like a short put, the solid line. How do you create that short put? Well, see the dotted line that goes across and down? What does that look like? A short call. Okay, so you short a call, and the line that goes up, you buy the underlying asset. So if you buy the underlying asset and short a call, combine them together, you replicate a short put position. Diagram B, what does a solid line look like? A long, not a call, long put, a long put. How do you create that? By buying or going long in a call option. That's the dotted line that goes across, then up. And then the line that goes down is just shorting the underlying asset, taking a short position in the underlying asset. Net them together gives you a long put. What does diagram C look like, the solid line? A long call, fantastic, a long call. To create that, you long a put option. It's a dotted line that goes down, then across, and you buy the underlying asset. Diagram D looks like a short call. Looks like a short call. You create that by a short put and shorting the underlying asset. And that will replicate the payoff, or the profit, I should say, sorry, from a short call option. Okay, this is more just for interest. Okay, this one here, not a big part of, I mean, it's pretty impossible not to be able to buy calls and puts nowadays, right? But where we get into it are our spreads and our combinations. So spreads are where you deal in only one type of option. So you deal just with call options or just with put options. Combinations, which we'll deal with in a few minutes, are where you deal with both call and put options at the same time. So again, we're concentrated on that solid line we see there. So the solid line you'll see, now this is called a bull spread. So everyone knows what a bull market is. A bull market is when prices are going up. A bear market is when stock prices are going down. So bulls are good, bears are bad, right? So this strategy, where do you make a profit? When the spot price is High or low? Look at the solid line. High, thank you. So it's like a bull market, right? You're going to profit if prices go up. So down here, prices are low, you'll make a loss, right? The solid line is below the x-axis. Over here, you make a profit if prices go up. And to create this strategy, using calls, you buy a call option with a low strike price and you sell a call option with a high strike price. So this is the call option with the low strike price you've bought, and this other dotted line over here is the call option with the high strike price that you have sold. So what you need to remember is, what is it? It's a strategy to make money if prices go up. How do you do it? Buy a call option with a low strike price, sell a call option with a high strike price. And then we think about, would this cost me money to set up this strategy, or would I receive some money from setting up this strategy? And you've got to go back to that table we looked at the beginning of the lecture. So that call option with the low spot price, is that going to be, the low exercise price, low exercise price. Is that going to be a cheap or an expensive call option? As X goes up, what happens to the call option premium? It goes down, right? Because you get a lower payoff. So you're buying an expensive option because you've got the right to buy for a low price. You're going to pay a lot for that. And you're selling a cheaper option because the person buying it is having an option to buy at a high price. They're not going to pay a lot for that. So this will require an initial cash outflow. The option you buy is more expensive than the option you sell. You can do exactly the same thing using put options. Again, prices go up, that's when you make a profit. And you do the same thing. You buy a put option with a low strike price, and you sell a put option with a high strike price. So same strategy, just replace the word call with put. You do it for exactly the same reasons. This one, though, does this require initial cash outflow, or do you receive an initial cash inflow? You're buying an option with a low strike price, so that's going to be a cheap option, and you're selling a put option with a high strike price, so it's going to be a more expensive option. Right? I'm seeing a few looks. So let me just go back to here. Remember, as the exercise price goes up with a put option, it becomes more expensive. So a low exercise put option is going to be cheaper. A high exercise put option is going to be more expensive, right? Because the payoff is X minus S. As X goes up, there's a bigger payoff. So the put option will be more expensive the higher the exercise price. Here you are buying a cheap put option and selling an expensive put option. So you'll get a small initial cash inflow. Then we have a bear spread. So a bear spread, name implies, market's going down. So this is where you can make some money if the market goes down. And you just do the reverse of what you did before. So this time, you buy a call with a high strike price, and you sell a call with a low strike price. We know with call options, the higher the strike price, the cheaper the option. Okay, the less expensive it is. So here you're buying a cheap call option and selling an expensive call option. So this will give you an initial cash inflow when you set this up. Again, you'll profit if prices go down. Of course, if prices go up, you lose. Right? You lose if prices go down. Go up. Create using puts. Same thing. Buy a put option with a high strike price, sell a put option with a low strike price. But now it's the reverse. The option you're buying is more expensive because it's got a high strike price. Remember, with put options, the higher the strike price, the bigger the payoff. So it's going to be an expensive option you're buying. The option you're selling has got a low strike price. The lower the strike price, the lower the payoff, so the cheaper the option. So this will require an initial cash outflow, okay, for your business. But again, if prices go down, you make a profit. Not an unlimited profit, okay, but a small amount of a profit. So what can this happen in an exam? I say to you, you think prices are going to go up, you're not sure, devise strategies for me about how you can make a profit. So you would talk, number one, about bull spreads. and some things we're about to look at in a minute. Now we have a butterfly spread. Believe it or not, it is called a butterfly spread because it looks like a butterfly. You have the wings at the side, look at the solid line, the wings at the side and the head in the middle. Okay, this is your butterfly. I don't make up these names. So, anyone, when do you think you would enter into a butterfly spread? What do you think is going to happen? Just look at the diagram. To make a profit, what has to happen to prices? The price has to be somewhere close to X2, the middle exercise price, right? Otherwise, you make losses down here. So how do you create these? You buy a call option with an exercise price of X1 or a low exercise price. You buy a call option with a higher exercise price of X3, and you sell 2 call options with a middle exercise price, which is X2. So buy a cheap call option, buy a call option with a low exercise price, buy a call option with a high exercise price, and sell 2 call options with a middle exercise price. It has to be exactly in the middle. And that's why you see that dotted line at the top, it's really high up, because you've had to buy 2 of them. Okay, so you're like doubling the profits if it gets exercised. Now, because option prices aren't linear, they don't go in a straight line. Okay, they actually curve up like that. You'll find that out later in the course. This will require initial cash outflow. Okay, will require initial cash outflow because it's not linear. If you can create them with calls, then obviously you can create them with puts. Same strategy. Buy a low exercise price put option, buy a high exercise price put option, and sell 2 put options with a middle exercise price. Okay, exactly the same as before. And like the other one, this will also require a small cash outflow as well. Okay, because the options you've bought in both situations added together will be slightly more expensive than what you'll receive from selling the 2 middle ones. And both the calls and puts cost exactly the same amount of money and will lead to exactly the same profit. So it doesn't matter which one you use. Then we have a calendar spread. Not because it looks like a calendar, but because of the timing of the cash flows. So again, a bit like the previous one, you're going to make a profit if prices stay close to the exercise price. If they don't, you start to make a loss. So in this one, with a call, you sell a call with a certain exercise price, and you buy a call with the same exercise price, but a longer time to maturity. That's the calendar thing. It's at a different time. Okay, so everyone should recognize the line that goes across then down. That's just your short call, selling the call with an exercise price of X. The one you've bought is the curved dotted line that goes like that. We can't express time on a 2-dimensional plot. So that is the way we represent the payoff from the long call option at a different period in time. It's not a straight line that goes up like that, it's a curved line that goes up like that. Because its exercise date is sometime else in the future. Okay, that's just the convention for how we do it. Combine them together, you get that kind of nice little shape. And again, if prices don't move much, that's where you'll make your money with a calendar spread using calls, and exactly the same thing with puts. Sell one with a certain exercise price, buy one with the same exercise price, but a longer term to maturity. And just to make things fun, guess what? Remember that question at the beginning, well, 5 minutes ago, where I said, I asked you a question in the exam, how can you make money if you think prices are going to go up a bit? Well, we had a butterfly spread. Guess what else we can have? Guess what this is called? It's called a reverse butterfly spread. Okay, a reverse butterfly spread. And it's just like the reverse of the butterfly spread. And to create it, you sell at a low exercise price, sell at a high exercise price, and buy 2 in the middle. So just the reverse of the before. So buy at a low price, sell at a low price, sell at a high exercise price, and then buy 2 intermediate. Okay, and that will give you a reverse butterfly spread where you'll make some money if prices go down a lot or up a lot. Okay, which is kind of neat. If you can have a reverse butterfly spread, then you can probably have a reverse calendar spread. I can never draw these. Something like that. Okay, so that would be your reverse calendar spread. Okay, this time you buy either a call or put option with an exercise price, and you sell an option with the same exercise price but a longer date to maturity. Okay, to get that reverse calendar spread. And again, you'll profit if prices go up or down a lot. So that is a reverse calendar spread. Now in your textbook, there are other spreads. You don't need to know those, just the ones we've covered today. What you need to know, what they are, why you use them, how you use them. And then you'll look at the profits in the toots next week. Okay, but you do not need to know how to draw these. Okay, we've had spreads, now we have combinations. Combinations are a little fun. I didn't come up with the name of these things. Okay, so combinations are where you use both call and put options at the same time. So this is a straddle combination. Okay, a straddle combination. You buy a call option and a put option with the same exercise price and the same date to maturity. So it's expensive, right? You're buying 2 options, both a call and a put. So again, what is it? Why do you use it? So why do you think you use this? Why would you enter into a straddle combination? What sort of stock do you have? Fantastic. A highly volatile stock. One where the price is either going to go up a lot or it's going to go down a lot. You don't know which way. And it's expensive because you've got to buy 2 options, a put and a call option. Then we have strips and straps. Okay, a strip, you buy 2 put options at an exercise price, and you buy a call option at the same exercise price. So you're buying 3 options, very expensive. Because you've bought 2 put options, you think it's a very volatile stock, but it's more likely that the price will drop. Because when the price drops, because you've got 2 put options, you double the payoffs. You get 2 times the payoffs because you've got 2 put options there. A strap, 1 put option and 2 call options at the same exercise price. Again, very expensive. You're buying 3 options, very volatile stock, but this time you think it's more likely that prices will go up. If they go up, you double the payoffs that you'll receive. So straddle, just very volatile. Strip, volatile, but greater chance price will drop. Strap, volatile, but greater chance that prices will go up. Again, really expensive. You're buying 3 options here. And finally, we have a strangle. So this time you buy a put option with a low strike price and a call option with a high strike price. So you're buying a cheap put option and a cheap call option. Okay, the put option has a low exercise price, so it's cheap. The call option has a high exercise price, so it's cheap as well. So it's a bit like a straddle in that prices have to be very volatile. You'll make the same amount whether prices go up or down, but it's a lot cheaper. But at the same time, to actually get a profit, prices have to move a lot because you've got that low exercise and high exercise. Okay, but it's a much cheaper strategy. Again, highly volatile stock. So you need to know what these are, when you'd use them, how you create them, okay, but you do not need to know how to draw them. Okay, you don't need to know how to draw them. Okay, are there any questions on today's lecture? So please remember, wait. Please remember you have a quiz today. Oh, sorry, this week, whenever your tute is. Okay, I want to be really clear about something. I put a notice up on Waddle. For your quiz to count, you have to sit it in the tutorial you are enrolled in. If you do not, you will get an email from me. Please explain. Okay, you must take your tutorial quiz in the tutorial you're enrolled in. If you, thank you, you cannot attend another tutorial. You may only attend the tutorial you are enrolled in. If you attend a tutorial like someone did last week that they were not enrolled in, thank you, sat the quiz and put a dodgy uni ID on it, right, you can be sure that there are repercussions for that. So let me tell you about academic integrity. We've got some time. Academic integrity. So academic integrity is basically cheating in some form or the other, right? So taking notes into an exam. You don't actually have to actively look at those notes to be caught for academic misconduct. The fact you had the notes on you is enough for you to get a ruling of academic misconduct. Attending a tutorial you're not enrolled in to have a look at the quiz, and then attending a tutorial later in the quiz you're actually enrolled in to take the quiz, is also clearly academic misconduct, because you're trying to give yourself an advantage over someone else. Taking formulas in a dictionary into an exam, also academic misconduct. An excuse of, it's not my dictionary, I borrowed off a friend, doesn't work. Okay, it's the act of taking something into an exam that you're not entitled to. So what are the penalties? Okay, the penalties range from 0 for a piece of assessment, right, all the way up to a fail for a course. And then if it's a repeat occurrence, then thank you for being at ANU, it's time to go. Okay? It is never worth cheating in an exam. In a quiz that is worth 3% of your assessment, I do not know why you would take that risk. Right? Because there's a high likelihood you'll end up, well, A, you'll get a record, you'll get 0 for that quiz, but you could also get 0 for the course. Okay, so please do not cheat. There is no need to. Absolutely no need to. On a brighter note, if you have any questions, I am down the front and I'm happy to answer them in the time we have left. And remember, your mid-semester exam is on the first 4 lectures, so today is examinable, okay, in the mid-semester exam. And there's no quiz next week, okay? There's not another quiz until mid-semester break, actually, so now you can just concentrate all your time in studying for your mid-semester exams for your various courses. Thank you. Let me just pack up.